Okay, thanks so much, Helena. It's nice to be back here at the CEEC. So many people I've known and really great organization, made so much progress over the years. And I think it's getting better and better, expanding its influence everywhere. So I'll give you an introduction to Tenaz. These are two really good presentations in this session. I don't think I can top either of them. And for sure, I'm not going to be able to give you the interesting lesson in Greek mythology that Giannis did, explaining where all these names in Europe came from. But I can tell you about Tenaz. So Tenaz, Spanish word, tenaz means tenacity. And our symbol is a shark because it too is a symbol of tenacity. I ask you to please note the advisories. We've got one at the beginning, at the end. These are also on our website. Not every slide is currently on our website, but the bulk of the asset description is, and I'll probably run through those ones that are already there pretty quickly and just focus on a couple of newer things at the beginning and end of this presentation. So the couple of things I'm going to cover, I'll give you an overview of the company. Then I'll very briefly go through the assets. And at the end, assuming we have time for it, I will have a little discussion about the European natural gas market. So the summary of the company, we are publicly traded on the TSX, symbol is TNZ. Companies founded with an M&A focus. The team that we have worked M&A a lot, both in North America and in Europe and Australia, among other places. And what we found, particularly in Europe, was that we could achieve these deals initially at lower multiples, better base rate of return than we could find in a much more competitive industry in North America. And then afterwards, typically we like to operate in the operating phase. We found that we could effect better improvements in the operations, more production, more reduction in cost, much better unit cost, better margins than we could if we acquired something in North America, where it again is just so competitive. And we had followed this model for a long time, felt pretty confident we could apply it. We formed the company 5 years ago. We went public through a recapitalization of an existing Canadian public company, venture exchange company called Altura, and then revised the strategy, renamed it Tenaz, moved up to the TSX main board in 2022. Today, we are the largest gas producer in the Dutch North Sea, actually really in the entire Netherlands, we believe, depending on what is on or off production for the other companies. Some days we may not be, but we think typically we're the largest gas producer in Netherlands entirely. We started with the recap with a Canadian organic development project. I'll try to touch on that briefly later, continue to grow that. Really the two most important events in the M&A phase of the company were the acquisition of NAM Offshore, now has been renamed TEN or Tenaz Energy Netherlands. We closed that at the beginning of May of this year. And then 5 months later, we signed and closed on the same day acquisition of a non-operated position in the GEMS project operated by OneDias at the Netherlands-German maritime border. So for us in Netherlands, it's all offshore. That's 85% of the production today. And the other 15% is the Canadian oil project that we got with the recap. Not sure which date this is on, but market cap about 650 Canadian, debt 360 million Canadian. I'll try to cover that a little more detail in just a minute. So EV around, as of this date, around a billion Canadian. Pro forma production with these two deals in place, about 16,000 BOED, 85% TTF. This year's CapEx fairly low, 100 to 110 million Canadian, because we only count the CapEx after the date of the acquisition's close, and a fair amount of insider ownership, about 16% for the DNO group on a basic basis, and if you count the fully diluted shares of the company with all the additional dilutives that exist, we'd be about 19.5%. The team really comes from a series of companies. When we created Tenaz originally 5 years ago, we had people in the team that dated back to Santa Fe Snyder in the US more than actually 25 years ago, through Dominion E&P in the US, Dominion Canada, Baytex, and Vermilion. Really, in general, a team that's been together for a long time. Jensen Tan, our COO, led the M&A effort at Vermilion. Brad Bennett was treasurer. Our CFO was treasurer and manager of finance at Vermilion. And in total, the 10 officers in the company, 9 of us worked together at Vermilion previously. We got a great board, one of whom is present in the audience today and gave a great presentation earlier, Marino with CMS. Marty Proctor is our chair. He ran 7 gens very successfully. Anna Alderson, audit chair, ex-KPMG audit partner. John Chabers, founder of First Energy, became Stiefel, et cetera. Independent dealer. Berenia Radu, our legal expertise on the board. Mark Rollins, engineer operating history with BG and other companies. And the board's been a big factor in our success with all that great expertise in these various areas represented. This is, I think, quite an interesting way to look at the company today. It doesn't date back to the very inception in 2020 or 21, when the company we recapped had about 900 BOED of production. But it's really the relevant part for today. And, you know, we have been an M&A focused company, and we will continue to pursue M&A. I think we got a very good pipeline. We don't know if anything will come to fruition out of that current pipeline or things we add later, but we'll attempt to. And I can assure you that if we make a deal, we're going to try to make it very value adding for the existing shareholders of the company. What this really focuses on is the go forward potential with the assets that exist in the company today. So what it really is about for us today, and the way we think of the company, is that we've got a, we think, quite good organic growth profile that is available to us, and we've got significant M&A upside that goes with it. So rather than, you know, being driven just by making another good transaction, which again we'll seek to do, it's really about having this continuous organic growth available in the assets that are in the company today, which we'll then try to augment with value-adding M&A. Again, this will be mainly in Europe. We focus more and more on Europe over time. So the data that you see here aren't internal company estimates. This is from National Bank Research. The analyst there is Travis Wood, a very experienced, very well-respected analyst in the oil and gas community. National Bank's an important partner for us. They were the underwriter of the recap. They've been in each of our debt transactions that we use to finance these 2 major acquisitions that I talked about. And they continue to be a very key partner. They're the lead of our, or they're a participant in our revolving credit facility as well. So again, this is National Bank Research, and what it reflects is this expectation of continued organic growth. You know, these, again, we haven't published guidance for 26 even yet. We're not going to publish longer term guidance for 27. So this gives us a chance to use independent research to try to give you a picture of what the growth trajectory with the existing assets in the company could be. And it shows pretty strong growth. I'll get to how we can achieve this in just a second. But you know, today we would be on a pro forma basis, 16,000 BOED with the acquisitions in place. The reason that 25 is between 9 and 10,000 BOED is because, again, we don't count the acquisitions in our production stream until they close. So potential to grow to in excess of 22,000 for 26 and in excess of 30,000 for 27. The cash flow impact under NB's price deck, which is addressed in the footnote to the slide, is pretty substantial. Potential to get up actually over $500 million Canadian. And I'd point out every monetary value in this presentation is in Canadian dollars, unless we otherwise note when we talk about European gas, we're going to put it in USD and dollar terms at the end. But with that kind of production growth, pretty good contribution margin from those incremental MCFs that would be flowing in, because there's a lot of fixed cost in this type of offshore operation. So not that much marginal cost associated with each additional MCF. You get pretty good cash flow growth under the NB price deck, which is probably a little bit above where the market is today with some of the recent declines in European gas. But nonetheless, the general point trying to get across is that we got a great opportunity for production growth, and definitely that should translate into some pretty meaningful cash flow growth, whatever the price deck is and wherever the numbers ultimately end up. And again, company is still quite focused on M&A, so there's potential to add to this with additional assets. The debt position of the company, as at the end of the third quarter, counting the debt that we took on and employed to make the GEMS acquisition, we would have a net debt number of $360 million. We also count toward this the estimated earnout payments that we would make under the NOM offshore deal. In the total, it's part of the net working capital for the current portion of the earnout, and in the long term, it's a long-term block there for the longer term earnout. Earnout's based on free cash flow, so if we invest more, that earnout amount goes down, and the earnout extinguishes in 27. To really finance the GEMS deal primarily, but we also put in place at the time of the NOM offshore transaction, we issued notes. First set of notes, 140 million Canadian, had a 12% interest rate on them. That was prior actually to closing the NOM deal, and one reason our rate was probably a little bit higher than our credit quality might have indicated at that time, to provide the addition. So a lot of that just went in the bank as cash. For the kind of top up for the GEMS transaction, we still have cash available in the company after this. We did a second tranche, really just a reopening of the same set of notes. That was 165 million to Canadian institutions, again in a private placement like the first tranche. Though the coupon is 12%, those bonds were issued at a premium, so the effective rate on those is 9.5%, coming down in rate, I think reflecting market, private market anyway, recognition of improving credit quality in the company. We think our debt ratios are actually quite low at this point. And the maturity date's the same, still callable in May 2027. So, good source of long-term financing. It meant that basically we didn't use much equity. We put a tiny amount of equity out to the private equity seller of the GEMS asset. Aside from that, we did not use equity to finance these transactions. We also put in place, at the same time that we announced GEMS and this second tranche of notes, we put in place a revolving credit line, bigger than our previous $20 million line, 115 million Canadian, with CIBC, NB, and Goldman Sachs. It is undrawn at present. Reserve summary for the company. This adds together the acquisitions, a pro forma basis, 92 million barrels equivalent. Reserve value per this independent analysis by McDaniel, 1.8 billion Canadian. If you want to come up with an NAV for the company for the 2P reserves as estimated by McDaniel, you would of course have to take off that debt number. There's also pretty significant resource potential, 135 million of contingent, and what we had evaluated for economic purposes in the prospective category, 135 million barrels equivalent, and then additional resources on top of that, bringing us up to this 214 total. Again, these are cumulative totals for those categories, not individual increments. So, to the extent that it was economically evaluated, there's also an estimate of the risked net impact to us additive to the reserve report as shown here. International model, I won't cover that. It's really about the M&A of the model and I touched on that earlier. Main focus for us is in Europe. We started off with a kind of a broader funnel than today, but we found enough opportunity to continue to consolidate in Europe, and so that's where we're really focused today. This is the asset section that's pretty fully covered in the deck that is already on the website, so I won't dwell on it. NOBV deal, we don't show a payout on that one. It was very, very fast because at close we had 8 million euros net in the asset, plus that earnout, 0 to 120 million euros, depending on cash flow and then how much we invest against that. The GEMS deal, at the time of release, about 4,100 BOED to our interest, and projected to be less than a 3-year payout at that time. So good deals, and the type that we would continue to try to make if they are available to us in the market and they fit our strategy for the company. It's a strong asset base in the Netherlands offshore. This is what we had prior to GEMS, really reflecting the NAM acquisition. Also ownership and all of the ownership or operation of all the 3 major pipeline systems and the biggest nameplate gas plant in Europe at Den Helder. A lot of development potential. GEMS, really a tremendous quality asset. You can see where it's located, right at the maritime border in the orange licenses there between Netherlands and Germany. There's one producing well currently on it, highest rate well in Netherlands, 75 million cubic feet a day, roughly. And a couple other discoveries that are yet to be developed, should be coming on over the next few years. It's powered by a wind farm in terms of the needs for the production process and drilling, powered by a wind farm on the German side of the maritime border. So basically no emissions in the production phase here. That's one of the lowest carbon signatures you could find anywhere in the world. And of course sells into the TTF market. Again, there's the existing pool to be developed further has that 75 million cubic foot a day existing producer. And a couple of discoveries that have been made but are yet to be developed. There's quite a bit of exploration potential. In fact, one of the prospects was mentioned earlier in the Enervis presentation. It's great Rotliegend, very continuous, very permeable, and we think pretty reliably defined for these prospects on seismic. We discussed the infrastructure, including the wind farm, which you can see from the platform. ONE-Dyas is the operator of this. They are the largest private oil and gas company in Netherlands. They also produce in UK. Very competent operator, and although we always like to operate and control wherever we can, we're very comfortable with ONE-Dyas. We think they have a similar philosophy about operations and sustainability, and they built a platform here that is very sophisticated. I would, visiting it, I was very impressed. I would call it state-of-the-art, very automated platform. And there will be an additional platform later as this development continues. We think the asset can grow substantially. This happens to be the projection by McDaniel, kind of up to our current capacity in the field of around 12,000 BOED net to our interest, which would be all gas. We have a great Canadian asset. This came in at the time of the recap with Altura, Altura's only asset. They had discovered quite a strong Canadian field, shallow, about 1,300 meters deep in the Manville. It's a horizontal multi-stage frac development in a sandstone reservoir. Just a few setup wells, vertical wells, low rate wells at the time they identified this field, started drilling horizontals with multi-stage fracs. Since we took it over, we've gone longer and longer, greater number of fracs, changed the designs a little bit, so the productivity has improved. We've also expanded it to the development to a couple other pools that are a bit more higher transmissibility, higher K over mu, where we're using multilateral horizontal wells with no fracs to develop in the Ellerslie and the Glauconite zones, kind of in the southern part of the land base here, getting some high rate wells at even lower capital costs than we got out of the initial Manville development in the Rex zone. So it's been very successful. It's a good field, grows, throws off free cash. You can see the growth profile that we've had since the recap. We're maybe close to 2.5x the production level that we had 4 or 5 years ago with Altura, and we think it can continue to grow at a pretty decent pace these next few years. So it's a good piece of the company. It's our main oil exposure as well. All this data is already reflected previously in various reports and presentations, so I'll skip over the guidance. I might spend, if I have just a couple of minutes left here, the time on discussing the European gas market. Probably most people are familiar with this. Related in USD per MMBTU, the TTF market in red, you know, we had the big spike at the end of COVID, and the beginning of the war. The blue line represents the cost, the full cycle cost, as we can estimate it, of LNG delivered to Europe. So you can see that currently it's very close to break even or even underwater, and it's kind of a tight race in the forward curve. Certainly these products are kind of working in concert in the market. You can see the Henry Hub price in green, again, USD per MMBTU, it's moved up a lot. The lower AECO price in Canada, still pretty low price product there in comparison to the European gas. You know, looking at the kind of the analysis of this market a little more historically in a previous fashion, we'd be very focused on storage, and I think it's still relevant. The storage curve for this winter season or this year in total is shown in the dark red curve. It's kind of low in comparison to most years. It actually has, and if you look at it on the right chart, that's the draw. It's actually been drawing pretty fast, even though the weather here is not particularly cold. So storage can become relevant. It depends on weather for sure. LNG has kind of removed some of the concern, I would say, about meeting winter demand. It's kind of a just-in-time delivery that can make up for carrying perhaps less storage. But nonetheless, storage is a part of the supply picture, and it's not very high right now, I would say. This to me is quite an interesting analysis. This again is another look at the LNG netback to Europe. If you look at the history in the dark lines, it's been quite high, right? There's a big opportunity for producers, midstreamers, depending on their position in the market, the assets they have, to capture a lot of value by bringing North American gas. I mean, this is from the US Gulf Coast to Europe. There is still a cost to producers, especially in Canada, but even in the US, to get it to the Gulf Coast that is not reflected in here and would pull these netbacks down. But this is the Gulf Coast netback to Europe. If you look at it today, the very end of the solid line, these netbacks are actually negative. The full cycle netback is negative. It depends on your contract situation, whether you should still ship or not, because if you have a lot of user pay, let's say on tolling or liquefaction in the US, you would probably continue to ship if you're going to pay those costs anyway. But the fact is, at the spot market, we would estimate that the netback for LNG to Europe, as of right now, is negative. And it's close to zero, as you saw in the previous plot, or depending on the analysis, potentially negative in the forward curve. So that has implications. You know, there's going to be LNG expansion in the United States and some other places in the world for sure, Qatar, among others. Historically, LNG has expanded for the last 25 years, actually quite a bit. And it has found markets as it's expanded. Certainly it has an impact on price. You've already seen that. But I guess one question that might arise, if the forward netbacks are negative, or if they're practically zero in the forward curve, or they're negative today, are really all those projects that are announced that the US government has announced permits for, are all these projects going to be built in the face of this kind of forward curve? Certainly you can't lock in a full cycle cost today that gives you a return on the project. So perhaps, you know, not all of these will be built. Certainly some will be. And again, we haven't, we're going to try to put some additional analysis kind of to give a historical perspective into our European gas section in the future. We don't have it just yet, but we're going to try to show how LNG has in fact been absorbed over time as we look at this next wave of liquefaction that's going to be put in place. And this is just a snapshot of the market for LNG deliveries. It kind of builds up all of the cost elements that occur in shipping LNG to Europe. The left side of this slide is in USD per MMBTU, and then we converted it to the units we're a little more familiar with here in euros per megawatt hour for TTF. In any case, at the prompt prices, they are negative, and even in the forward curve for 26, in this snapshot of the analysis, they're negative as well. It does depend on the date at which you analyze this. So we think TTF is a good product. Probably these prices, these delivered costs, give you a rough idea of where the floor would be, at least on a full cycle cost basis for TTF, and we're trading just a little bit below these numbers today. We do hedge as well. This data has been out there for quite a long time. We're actually more than half hedged for TTF for rest of 25 and nearly half for 26, building a position in 27 now. We already had hedged ACO quite a bit. We really are, for our more limited oil portfolio, we run unhedged at present. So that is a summary of Tenaz. Again, for us now, it's really more of an organic growth story that with the potential to, we hope to augment through additional M&A. It's a model we've run before. We like this region. We believe Netherlands is a great place to operate. The government is very supportive of the offshore development, as indicated by the recent sector accord between the industry and the ministry. And we hope to expand over time through both organic and M&A activities. So thank you very much. It's good to see everybody here again.